Hello and good morning, folks. It's the end of the week, but not in need of saying TGIF or as we usually use. Thank God it's Friday. Although the week was eventful, markets remained in a saner mood, at least in our time zones. Some volatility was prevailing in the off-market hours right after the US Federal FOMC meeting and last evening's BOE meeting, after which the Bank of England came up with a rate hike as well as the world over central banks are having their synchronized efforts towards taming the so oftenly mentioned the inflation animal. So PR, what's your take? What is going on in the markets and what should we be expecting out of the markets?
So good morning everyone. I would like to really congratulate Mr. Powell, and he has got his art of communication perfect. Whereas FOMC statement appeared dovish, the press conference was apparently hawkish. Now, if we combine both, it was a kind of a hawkish tone, which is a requirement of economy and market in US. If we see that the Thursday was in a fact of a continuation of sentiment carried from the previous session, with the market still digesting hawkishness and no pivot from the Fed, trying to discover what could be the new level for yield, what could be the new terminal rate. It seems that market now started pricing that the rate hike would lead into a 5 to 5 quarter range by June 2023. The message from Fed was very, very clear that they are not very close to the pause. Leading to this, dollar has surged nearly 1.5% since Fed decision, reflected mainly in the major currencies, with sterling perhaps taking most of the hit after UK raising rates also 75 basis points, but indicating that they would not be requiring rate to go up to as high as 5%, which is market is expecting. DXY was ranging between 100 and now basically it's expected that DXY will range between 114 and 110. My assumption is that 113 quarters would take a kind of a resistance, with Yen and Yuan looking more vulnerable despite interventions. So we are seeing that the Yen and Yuan interventions are there, but they continue to look weaker. What would actually decide that how much inflation central banks can manage and how much currency adjustment they would be allowing to do that? And I think that's the biggest conundrum Indian central bank is leading into. Incoming data yesterday was in fact weaker than expected. ISM non-manufacturing index printed lower than expected. It was 54.4 versus 55.5 expectation. It was lower than the previous number also, which was 56 plus. Along with this, factory order also showed a negative number, minus 0.1% versus 0.1% expected. The final trade figure was also, September trade balance was also worse than expected at 73.3 billion versus 72.2 billion. So I'm just saying that everything was, data was lower, was worse than expected, but Fed statement prevailed in the market. 2-year, 5-year and 10-year touched respectively 475, 444 and 422. After that, there was some buying came in, and now they are dealing at 471, 435 and 415. The inversion of yield curve is very, very persistent. Now, coming to incoming data, which market would be looking into. Today is a payroll data, which Reuters forecast is 200K, 3.6% unemployment rate and 0.3% average hourly earning rates. Any numbers higher than this, except unemployment rate, market will get further, dollar will get further strengthened. Now, I would say that Fed September projection had indicated unemployment rate reaching up to 3.8%. And we will have basically two data point before the year end. So let's see how much number is getting closer to 3.8%. Previously, the unemployment rate number printed was 3.5%. Coming to dollar rupee, I think most of the uplifting had been done by central bank yesterday itself. Once dollar rupee tried to cross 82.90, we have seen PSU banks were continuously offering around 82.90. Offshore markets, we are observing for last couple of days, they are buying in rupee. There is some selling in dollar against rupee in the offshore market. Today also the offshore market currently is quoting around 82.65. We expect a range of 82.55 to 85.90 today. In reaction to the Fed statement and the bond yields, Indian bond yields, 10-year bond yield also moved by 4 basis points. RBI had completed its MPC yesterday, and the meeting was to discuss response to central government on inflation numbers. And that's why there was no outcome announced yesterday. Thanks a lot. Thank you. Have a very nice weekend.
Okay, wonderful, JK, PR. And miss I miss doing sessions with you, PR, so that's why it's not really right on the tip of our tongues, but apologies. Any which ways, BOE indicating no need for terminal rates as high as 5% was somewhat off from what exactly the US Central Bank was mentioning the other day. So there's quite a conflict amongst the central banks on the forward guidance as well, while the synchronized rate hikes continue. Although the macros on the US front do look weaker, as PR mentioned. So it's not all rosy or the amazing picture that we are seeing when it comes to economic performance. And another indicator which is widely used in the financial markets over the years has been the inversion of yield curves. Now, it's not necessary that the inversion of yield curve shall bring in recession, but it has been quite good an indicator of the same. So, folks, there has been a lot of changes in the financial markets, and we are in those times where there is in sane amounts of activities happening across all the major influencers of these financial markets. So we hope you keep managing your risk and have some fun while you are seeing these financial markets move in your favor, as well as risk is managed out of favor should not be a question. That's it for today, folks. We'll come back again next Monday with another round of updates for you with Almus Market Mornings. This is Shikhar signing off. Thank you.